All right, it is shortly after 3 p.m. London, 4 p.m. on the continent. I'm actually ringing in from New York, where it's 10 a.m. and we will get this webinar started. Thank you very much for joining us today. Um, my name is Tim Craighead. I'm the Senior European Equity Strategist and one of the research directors at Bloomberg Intelligence. And on behalf of Evenco, we'd like to welcome you to today's webinar. I'm here with another Bloomberg Intelligence colleague, Rob Barnett, and we hope that you'll enjoy this insightful discussion, we believe, about investing amid energy transition. We're joined by three senior experienced investors from across Europe. Julien Jarmoszko from SFP, Joel Etzler from Coeli, and Mariano Unali from Kairos Partners. And we are all over the place logistically today with Stockholm and Geneva and Milan, Zurich, and New York being represented. So quite an interesting day. And we do appreciate those of you all in the UK who are taking time out from the interesting TV coverage today about the Prime Minister to join us. Quite an eventful day for sure. Let me give you a little bit of housekeeping and background information. What we'll do is run through a couple of logistics up front, and we'll then segue into a bit of a stage setting for this topic that we'll provide, and then spend the vast majority of the next 45-50 minutes with a good panel discussion amongst all that are here on the webinar. So by way of background, as I said, Evenco has worked to pull this webinar together. It's a great team that actively brings together asset owners and allocators together with fund companies. I've had the pleasure of hosting several of these events across Europe this year, and there are many more of these yet to come. You can see a few of these that are set in the remaining couple of months of the year ahead. Evenco Analytics is also part of Evenco that's got investor survey data that is quite intriguing from the standpoint of a finger on the pulse of investor sentiment and positioning. We're actually bringing some of this on the Bloomberg terminal within our strategy work as a pretty interesting touchstone. And Bloomberg Intelligence is the research arm at Bloomberg. Full breadth of coverage from strategy across asset classes to industry, outlooks across regions, and actively managed primers on 2,000 company and credits. We have a very deep ESG effort as well that's clearly related to this topic we're discussing today. And all of this is available on terminal. Now this webinar, it's the second of a series in topical discussions that we're calling Trend Watch. These are each taking place at the end of a given month. Last month, we started off with investing in the midst of elevated sustained inflation. Clearly, we're talking about energy transition today. Next month, we're set to be looking at positioning into 2023, and the topics will continue. So with that in mind, let me set a little bit of a stage. We've been talking all year about what we call the 3Ds and a paradigm shift in inflation that has broad implications in through the market. The 3Ds, deglobalization, decarbonization, and demographics. Clearly, Putin's war is exacerbating the situation with implications for the decarbonization and the deglobalization elements of those Ds. And there are repercussions across the market. if we think about what we've seen in the world of energy, we've got elevated prices. Clearly, from a historical perspective, we can carry this back a little bit farther, and we all remember back in the early teens, there were also elevated levels of various commodities. We foresee this continuing for a host of reasons as we look ahead. Clearly, that's got implications in through inflation, which certainly is elevated. We expect to back off some, but we're not looking for this to go back to pre-pandemic levels. This carries through in various ways into the markets. And this is a look at the earnings contribution by sector into the FTSE. And you can see with that orange line what's transpired over the course of this year, looking at 2023 expectations. Energy is the largest contributor to the UK market in earnings now. Granted, this is an exceptional case relative to other markets, but it's representative of how energy has changed as a contribution to the world of equities. And we can see what's transpired from the standpoint of performance this year. Energy has just rocketed relative to everything else in the market. And on the right-hand side of this, you can see our sector scorecard that we do on an ongoing regular basis within the strategy work we do at Bloomberg Intelligence. And energy has been one of the top 3 sectors in our work all year long. It still is. It wouldn't surprise me if it continues as we look into next year with the first quarter. This is a bit of a tactical intermediate term element of the strategy work we do. And with that said, I'm going to flip this over to Rob, our senior clean energy analyst, to go through a couple of slides as well.
Okay, thank you, Tim. Given my line of work, I'm obviously predisposed to think that the energy transition is exciting, and I think it's a big macro trend that we're going to see unfold over the course of the next few decades. Now, a quick framing chart. This is the global supply of clean energy that we're showing on top. On the chart right now, you'll see natural gas, coal, and oil make up the bulk of the energy we use as a society today. Now, that being said, you see down at the bottom, there's this tiny little bit of orange, tiny little bit of white, tiny bit of blue. And that is basically nuclear, hydro, and renewables, so wind and solar. And so a couple things. One, I think the folks who don't believe in the energy transition love to show this chart. And they say, oh, look, you can just ignore the quirky little renewables or other things that are unfolding out there. But I would say, this is a chart you got to pay attention to because the exciting stuff is really happening at the bottom of the curve there. Yes, renewables are going from a really small place, but they're growing quickly. So next slide, Tim. This is the chart of wind and solar capacity additions. This is just simply history. Very hockey stick looking chart. The pace of wind and solar capacity additions is just roaring. Allow your mind to extrapolate this chart and think about where it may go next. If you believe that we are going to approach a net zero world or anything like it, this chart is going to continue to accelerate in our view. If you think about the last chart where we're showing the whole energy system mix, look, it took a century to do that. And it's going to take, 30, 40 years, and we're going to try to replace the whole piece of oil, gas, and coal, and trying to do it all with some mix of nuclear, solar plus wind, and perhaps a little bit of hydrogen or some other things mixed in. We can talk about what those might be. And then if we could just go to the last slide, because this is all about how do you invest around this theme. Look, at the end of the day, solar companies on the left-hand chart, they're the orange bar. Solar companies have declined about 10% this year. This is if you look at the BI theme basket for solar. Now, the overall market's down around 25%, so they've outperformed, but I know investors, they don't want relative return. They typically want absolute return. The World Energy Index has done a little bit better because of that linkage to oil. Now, if you zoom back, the chart on the right on the screen, look, the solar stocks over the last 3 years, they're up about 2x, whereas the world market or the energy exposed, the more oil-linked names are kind of flattish. So solar, depending on when you look at the space, has done well in the past. And well, how's it going to do in the future? If you look at those 3Ds that Tim mentioned, solar or wind, they offer decarbonization. If you look at the Inflation Reduction Act or Repower EU, there's a lot of discussion about onshoring that supply chain. The tax incentive for solar or wind in the US is much higher if you do it using domestically made solar panels or wind turbines. And demographics. Look, we all saw some protesters throw a can of soup at a Vincent van Gogh painting just the other day. Well, that's the demographic piece. A lot of the young people, they want to see the solar, wind, and other energy transition things happen. They want it to happen faster. And I think it is going to happen pretty fast. And I think the question is whether those traditional energy companies, the BPs, the Equinors, the Exxons, the Chevrons of the world are going to participate. I think they're going to, but that would be a fun part of the discussion to have here. So with that, let me hand it back over to Tim, and we'll get going with a fun group chat here.
Yeah, that sounds good. Look, and I will mention that you'll find what Rob does on the terminal, on BI Go, and all the work that we have on strategy, you'll find on BI Stocks E and BI Asset from an asset allocation perspective. So I'm going to stop sharing the screen and we're going to get to the main event. Can I bring on the 3 panelists and just have you give a brief perspective on who you are and where you're coming from and why this topic is of interest to you, and then we'll get into the crux of things. So Julian, let me ask you first. And you're still on mute, Julian.
Yeah, so I'm the CIO of SFP in Paris. We serve affluent and high net worth families mostly in terms of their financial management. In terms of my life, I've been a bit of a cat. I had several lives. I was a fund manager on long only and absolute return products, where I was mostly interested in governance issues. I was quite activist in that sense. And after that stint in investment management, I worked for a data company, S&P Global. I helped integrate TrueCost, the environmental data provider. So it gave me a bit of a view on environmental data. And what brings me today to the panel is obviously we have a lot of regulation thrown down our throats about ESG, but mostly, it's when I look at my dealings with my clients who now have 80 and 90-year-olds phoning us and asking what they can do with their portfolios to help the climate change, because everybody is seeing that the climate is not behaving like normal anymore. So that's why we have a unique mandate to act.
Indeed. Thank you for that. Joel, let me bring you in. A little perspective on you and what you're thinking.
Yeah, sure. So my name is Joel Etzler. I, together with my business partner, run a fund called Coeli Energy Transition. So it's, as given by the name, we're clearly interested in this topic. This fund has been up and running for about 3 years. The sole purpose of the fund is to extract alpha in the energy transition and to drive impact and make a difference. I've been investing in energy for the past decade. Before that, I was an investor in technology, both on the private equity side and long only. And I'm based out of Stockholm, Sweden.
Excellent. And as I've experienced in a couple of Nordic events over the course of the past year, the passions are high when it comes to related topics like this. So excellent. Mario, last but not least.
Hi, everyone. My name is Mario Unali. I work with Kairos as a senior PM for alternatives. I manage multi-manager funds and commingled funds and separate accounts with a multi-strategy mandate. So I've been doing this for more than 15 years now, and we are cross-asset and cross-sectors. But we've had a degree of exposure to energy, since the very beginning of this program, which, dates back to 21 years ago. As of today, we have the highest exposure we have ever had. So I think it's a timely and relevant discussion today for us. And we really take the allocator perspective in the way of, allocating to the best opportunities. We don't really have to be in each and every sector. So the fact that we are in energy in size means that this is very, a very relevant discussion for us and hopefully for everyone. So thanks, Tim and Rob, and thank you, BI and Evenco, for organizing this.
Super. Well, look, let's dive in. First question, and you all have alluded to this in various ways already, is, do you perceive this overall theme as an opportunity or a threat? And maybe it's a little bit of both, but can you give some context around how you and your team are contemplating this broad topic? And we don't have to keep going in the same order, but Mario, you just finished. Why don't you sort of segue into a little bit more perspective on this?
Sure. I think, obviously we are very constructive, and we believe this is a big opportunity from an investment standpoint these days. The reason being, I think, first of all, the time horizon of the investment theme is very much in line with what you want to have as an asset allocator. So we're talking about something that will develop as a process, not just as a short-term opportunity. So if you're a speculator for today or tomorrow, this is probably not for you, because as we have seen in the charts, things can be very volatile, and unless you're like a short-term trader, you risk losing a lot of money. But if you can incorporate the longer-term view, and that's what we all should be doing, right? Investing for the cycle, 3 to 5 years. That's when really things could play out in a positive manner for the investor. So once you accept this has to be in your portfolio because it is a long-term opportunity, or at least a medium-term opportunity, the next question is, how do I play this thing? And as someone who manages like a very broad investment mandate, the beauty of this theme is that you can be invested in a variety of ways that are not necessarily directional. So you don't really have to be long something, short something. There are a million of relative value plays. There's something that you can do with a very decorrelated approach compared to equity and fixed income markets, which turns out to be useful in years like this. And we are not guaranteed a V-shaped recovery this time in the traditional asset classes. So I think it's a big opportunity. And the other perspective I like to take on this is, we like to talk about the energy transition as something new, because we're dealing with renewables and with sources of energy that are just becoming popular in this day and age. But if we look at the past, there have been a number of energy transitions, and they've all brought innovation and opportunities for the investor. Think about the switching from using coal to gas. Think about a few years ago, some of the renewable sources became economically viable, and so we didn't have to rely on subsidies anymore. So this is a process that's it's very long. It's happened before. It's in line with our mandate, and most of all, like all interesting trends, I think it's cross sectors. So when we talk about the energy transition, we have in mind, obviously, the energy sector, and that makes a lot of sense. But if you think about the ramifications of it, you see that many of the sectors you're invested in will be impacted by this process. It's just like tech, right? I mean, tech is one sector, but then obviously permeates and influences a lot of other names in our portfolio, themes in our portfolio. So definitely something to take a look at, and definitely an opportunity rather than a threat.
Oh, that's cool. Julien, thoughts from your perspective on this?
Yeah, so some of the thoughts, I think obviously the opportunity is there, but there's a lot of complication for me as an asset allocator. First, there's I want to avoid the simplistic view on energy transitions, as Mario was alluding to, that I just need to buy Ørsted or those firms and then we will be fine. The second point is, the energy transition has a lot of hurdles in front of it. There's the availability, for example, of raw materials. If I could look at the Escondida mine, the biggest copper mine in the world, its ore grade has gone down by a factor of 4 times in 30 years. So there's not a lot of thinking through that. I find that would there be availability of all the materials and supply chain to do all these investments. The next point is the return on investment, return on capital of all the firms that will be invested. Lithium mining needs to go up 10 times at least to match the rise in electric vehicles, but will mining companies be profitable doing so? So it's very well, a lot of people have their top position in Albemarle, this mining company, but they need to increase massively their production. Will they make money doing that? That's in the asset manager presentations, we'd never have that conversation. And last but not least, I think entry points are very important. If you look at oil prices, oil demand has gone up since 2000. There's only been 3 years down, very slightly down, and yet oil prices have been all over the place. So there's a lot of volatility of prices are associated to energy, and it goes to share prices. So entry points are very important. We had a very big bull market finishing last year. So it remains to be seen if today is a good entry point to play for the very long run.
Oh, fair enough. And last but not least, Joel, you're clearly engaged in this topic.
Yeah, we spend a lot of time, thinking about this, obviously, but clearly I think it's a massive opportunity. But I think it's quite an interesting, question, because it's interesting to think about what are the threats. If you look at what's been happening currently, what's happening now, that we're in an energy crisis in Europe and actually most of the world outside the US. So where has this come from? One of the reasons is that we've tried to stop producing a lot of these energy sources that we actually still need. So Europe's domestic gas production has been falling, for the past 10, 15 years, and we decided to then import it from Russia, etc. I think the discussion has been very one-sided in the sense that we should just stop drilling for oil and gas and coal, and then we'll have transitioned. Unfortunately, it's not that easy if we still have demand for the products. So what we worry about a lot is, will this cause the energy transition to accelerate or slow down? Because if we end up in an energy crisis and economic recession, and governments have to spend a lot of money just to bail out us or put caps and windfall taxes on producers of various sorts of energy, fossil fuels, for instance, that could be a big problem. So we could definitely end up in a position where public opinion, which has been a very strong driver, a big supporter of the energy transition, and the push away from fossil fuels, could be turning, and that's a worry. So it probably needs to be quite balanced, although when you have very high prices of gas and oil and so on, that clearly drives demand for people to put up solar on the rooftop. And now in Europe, it's tremendous growth, right, in how much people are putting up, trying to invest and just to save energy. So that being said, we definitely think it's a big opportunity. If you think about the task we have ahead to 2050, it's massive, right? And I think there are loads of different estimates out there, but I believe that UBS had one, which was that we need to invest $140 trillion, over the next 30 years, which is 3 to 4% of current GDP every year for the next 30 years, just in order to, reach net zero. So is it an interesting space? Yes, I think so, definitely. It's going to grow. I think it's probably quite interesting both to understand the fossil fuel part and the renewable part, as there are investments that need to happen on both sides, and I think the energy sector as a whole will grow in both names of companies to look at and certainly in terms of investment, and it's changing the system. The system is changing, so it becomes more dynamic in the sense. So all in all, we think it's a big opportunity, but I think it's worth thinking about the potential consequences of doing it the wrong way.
Joel, I want to follow up on that because I think there's a great question that sort of, there's a big debate around the idea of whether traditional energy companies are going to participate in the energy transition. I know you just said you think that it's much more complicated than just simply stopping drilling for oil and gas. So can an Exxon, can a Chevron, a BP, Equinor of this world be an energy transition play? And sort of the nuance, I think, within that to me might be, well, what's the return profile look like for some of the energy transition type investments versus a traditional energy investment? Would love to hear your thoughts on both of those ideas.
Yeah, that's a great question. So I think that, well, you have to think about it in maybe a couple different ways. One is to think about like how much of their current business, potentially could they be contributing? That's one way of thinking about it. If you followed all the, ESG type of frameworks, it'd probably be quite small now. So maybe people would say, yeah, there's no point. Like these guys are still fossil fuel producers, and that is all true, right? However, I think it's worth considering or, lifting your view a bit and thinking about what are we trying to solve for? We're looking at 55 or so gigatons that we're currently emitting, and they are coming from various different sources. I think about 75% is from energy in some capacity. But if you break down all of the different subsectors in terms of where the emissions are coming from, I think a lot of people would be quite surprised, right? That you have maybe 8% of all the emissions are coming from cars. So if every single car in the world was electric and charged by renewable 100% of the time, then we would cut 8% emissions, assuming there's no emissions when building them, right? So we have 92% left. I think a lot of people think that maybe, we just need electric and some batteries and then we're done. Unfortunately, we have cement, which is another 8%. We produce 4 billion tons of cement every year globally. So 500 kilos for every man, woman, and child on Earth every year is used, right? So when you start to think about that, steel is another 8% or so. So I think definitely if we think about who's going to help solve a lot of these kind of, people usually call it heavy industries, there might be definitely a big role they could play. So some of the some of the problems, if you would call them that, like cement, is the likeliest scenario is probably us using CCS. It's likely the most straightforward solution, right? And then who's going to be good at dealing with those gases and putting them into some sort of underground reservoir? It's probably the oil companies, and they're in fact quite big in it already. And then if you think about decarbonizing steel or another type of heavy industries, in chemicals is also huge emissions. Hydrogen is potentially a big solution, and there are a lot of up and coming companies in that space, but there's also, it's about handling gases and pipelines and large projects. And if you look at offshore wind, they have a lot of experience in terms of working with big offshore platforms and big not just a wind turbine offshore, but maybe there's a electric station out there as well. So I definitely partly we need more oil and gas in the short term. There's like I said, there's a pretty big risk that if we stop investing, we'll end up with an energy crisis instead of an energy transition. And then we turn people, people say, yeah, I don't care about the energy transition in 2050. I just want energy right now, and that's a big risk. But I think they also have, they do have a lot of things where they could contribute, but it's important that they do it.
Mario, I would love to get your view on this as well. What do you make of the idea? Can a traditional energy company participate in the energy transition, or are they, do they have to live with the legacy of what they've been in the past?
You know the answer to this, right? No, I mean, they're a big part of the process, of course. I mean, first of all, these are massive money machines, and they have the resources that are required to facilitate this process. So the world cannot do without. I think one important part is investors' approach. If you are dogmatic, if you are someone who only focuses on energy transition in the way of renewables and clean energy, obviously you are cut out of this universe, and also you run the risk of shorting this part of the universe. So as an investor, you run a factor risk that is very difficult to control at the moment. And the second observation I would make is that these companies are working hard on changing their own perception with the public. Massive investments are going on, and they are trying to be perceived no longer as the bad boys of the heavy industry polluting, devoted on fossil fuels and making a huge amount of money by making the world dirty and killing people. But they are in the process of switching into, for example, suggesting and facilitating energy savings. So huge amount of marketing and PR investments are going towards this transition from one business to the other. So yes, they will be part of it. Investors need to take an open mind, because sooner or later they will find themselves invested in very different animals. I mean, these today and until now they have been something, but from now on they will transition into something else. That's our view, and that's why we are taking the non-directional approach, because at the moment we are long these traditional fossil fuels related companies, but tomorrow we might as well take the other side of the trade, and we really don't make any consideration regarding what they are today, because we feel like they are evolving animals.
And
Julie,
yeah, go ahead, Rob.
I was just going to ask Julian, just what do you make of the idea of an evolution that includes the traditional energy players? Are we all in agreement here that this is you play the energy transition by being in the traditional energy business?
So I'm going to build on what my two colleagues have said, and I'll take the example of Total Energy in France, my home country. France uses 1 million barrels of oil every day for transportation, roughly. So this is 65 gigawatt of capacity. Let's say that we can have a mix of nuclear, hydro, and renewables. We'll need probably double to cover that, 120. At the current cost of construction, that's about a net zero in 2050. So we want to finish in 2050. That means 10 billion euros to invest a year. And Total in France pays 10 billion euros in dividends per year. 1/3 of its investment is in green energy, and 2/3 is in old energy, which is probably needed because there's a diminishing law of returns there. So I guess what I'm alluding to is the 6 majors could decarbonize transports for most of the Western world if they were stopping dividends. So that means a reconfiguration of how they use their cash flows. And there was an opportunity in 2020 with COVID when they all started cutting dividends. But we've seen with Shell, with BP, etc., that they reinstated a bit of the lost of the cut dividend, and they grow it, and they want to grow the dividend. So to me, we had a lost opportunity there to get them to really shift towards one of the major enablers of the transition. So probably what needs to happen there is that asset owners need to gang up on those majors and force them to reallocate capital in the future. because that will come for more engagement from their part. And then I think there will be a model for all the energy companies to follow.
I like the idea of engagement, and maybe want to follow up, because I think there's a lot of question out there about what is an ESG investment. And, you know, if you look in the US, there are ETFs that exclude Tesla, but include Exxon in major ESG funds. You were talking about Total Energies, but you know, what is the right metric or set of metrics to be thinking of for this kind of question? Because I mean, you were talking about engagement, but what are the signposts? What are the data points you look for, or that your clients are asking about?
In terms of engagement, or in terms of?
In terms of ESG, you know, how do you really evaluate whether that engagement's going in the right way that you mentioned? Julian, we'll start with you.
Yes. So I think engagement is I think, when I invest in funds, one of the weakest point there in terms of the whole ESG mantra. I think a lot of asset managers are forming groups, forming coalitions to try to instigate change. But we had an example with Exxon like a couple of years ago, where there was this hedge fund got a board seat, and since then I think it's been relatively quiet in terms of the engagement from my side. I don't think we see a lot of appetite from managers to engage from the funds I meet. I don't think it's the priority out there. They're a bit busier making sure that they do their job as fund managers first, and I think that's where maybe it's a European culture where we're failing on the engagement side, I find.
Joel,
I was going to say, I don't think that that's a European element. I think that's a global element. Go ahead, Rob.
Yeah, well, I wanted to keep the discussion going around the sort of metric side of the equation. I want to come to Joel. You obviously take a view across both the clean energy space and the traditional energy space, seeing them as both potentially part of the energy transition. So, you know, what is the right set of metrics to really evaluate this kind of question? And because I still think we're confused on, you know, what does ESG really mean? So how do you think about it from a metrics perspective? Is it simply the carbon emissions of the company, something else, a set of things?
Yeah, this is a big topic. Yeah, so like, if we just step back from the whole ESG thinking and just try to figure out what we're trying to achieve, then we might end up with a slightly different answer than what metrics are we looking for in terms of how we should measure a specific company or a specific sector. Like, we have a framework, right? We have the EU taxonomy. So there are rules coming to the EU. We know exactly what they are, and they are well, let's say they are making it a lot easier if you're just excluding, right? If you just exclude everything that's heavy emitting, you get a good profile according to the taxonomy, right? So that, I think, is potentially a problem. And then we get into the engagement part. Should asset owners be engaged with the companies? And I think yes, I think definitely. I think if we are not trying to make it better, then what are we doing? So if you come with a portfolio that's filled with cloud businesses and healthcare and tech, you know, you're not going to make the climate any better. You know, you might have a good return, maybe, but it has nothing to do with, you know, decarbonizing cement or steel. You know, if you're trying to solve some of the bigger problems, what are you doing? So that, with that backdrop, I would say what we do is, first of all, we're market neutral, and we have a commitment to always be net short fossil fuels, that just to be active in the space. And that allows us to be there and have discussions with the companies. But our, you know, investors capital is not directly contributing to the space. Although I think in some cases, these companies probably do deserve that you invest in them if they are best in class, if they're really trying to push the envelope. But in terms of measuring it, I think it does make sense to look at their relative CO2. If you think about traditional energy or metals and mining or one of these heavy emitting sectors, look at it in terms of emissions as a percentage of the energy output. Because what we really want them to do is to keep supplying energy. We know energy demand keeps going up. People need more energy, but we just want it to slowly shift, right? It's very difficult to just remove the supply side and say, Shell was taken to court, right? When forced to say, we have to reduce our emissions by X. Okay, so let's sell some of our assets to some private companies and they can keep producing it. That doesn't really help the climate. They can also try to reduce, close down fields of oil and gas and whatever, and then start producing more or building more wind farms and solar farms, etc. If they're replacing the energy and then there's demand for it, so there's EVs, so there's other ways to use that those electrons, then I think that is the way forward. So that's why I think looking at the CO2 emissions in terms of the energy they produce is relevant. Because if it's someone who actually contributes a lot of energy to the world, it will be very difficult for them to maybe decarbonize as quickly as someone who's producing a lot less. And what we like to do is, we talk to the companies about what do they have in their plan in terms of disclosure, for instance, the Carbon Disclosure Project. Think about, are you, first of all, do you have a plan? Do you have targets to reduce? What is your current emissions? And then we can drill down and discuss where are the potential areas to save anything. And many companies in the US, they don't have even their scope 1 and 2 emissions yet. They don't know what they're emitting. They have an idea maybe where the biggest problems are. But I think that is certainly, that pathway. And then how can you make it faster, or what are the things you could improve? That's, I think, low-hanging fruit in terms of making or reducing global emissions.
Couldn't agree more. It's very hard to control something that you're not measuring. Mario, I want to come back to you. I mean, what do you make of this idea? Emissions per unit of output. What else is out there in sort of the ESG sort of scope of things that matters from a data perspective or sort of an investment selection perspective? What are the things you're looking at?
Well, first of all, there are the S and the G, and this is probably not the topic for today, but they are part of the overall assessment. As far as we're concerned, I agree with Joel. The EU taxonomy is very much the reference point for our assessment. And as a firm, we are an asset management company. We launch funds, pretty much every year, and we have taken like a very clear stance that all new products are going to be ESG compliant in the strictest way. And in terms of the multi-manager products, those that are European or within the UCITS framework can only invest in Article 8 or stricter. So definitely there is something going on the commercial side. So we want to make an effort to appear as an active player on that side. When it comes to investing, I think it becomes a little bit trickier because clients are very happy for you to be involved in ESG and to be careful what you do on that front. But first and foremost, they want to make money. And the unintended factor exposure that I was referring to a few minutes ago, I think it's exactly what you don't want to have and what you need to avoid, because otherwise, clients sell you not because you're not ESG compliant, but because you lost their money. So you don't want that to happen. So we need to remember what is the number one priority of our activity. And in terms of what I do, I make a number of hedge fund investments as well. And I think on that front, there is not very much going on in terms of yes, a lot of the largest players are starting to have policies, and they claim they have big presentations and big pitch books around how attentive they are. But then, at the end of the day, they are not an ESG compliant product, and they really don't really care. So these are the people that move the markets, and this is the so-called smart money. And if you look, I was in the US last week for the week, and I didn't even meet one manager, not even in the energy space, who really cared a little bit about this. The European landscape is very different, and obviously it's a good development, and obviously we agree with that. But then what really drives markets is US money, is hedge funds in the US, and to be honest with you, we're not seeing much going on there.
So knowing that, and thanks for the insights on all of this, I think it's fascinating. We've got about 10 minutes left, and in the midst of an energy transition discussion, we have to talk about alternatives, clean energy, if you will, as opposed to traditional or what have you. So in a brief bit of perspective, because it'd be great to get all three of you in, and Rob, a little of your perspective in this as well, given that this is your area of expertise. What's the most intriguing element of clean energy that can be added to what all of you all are still invested in from a traditional energy perspective? So, thoughts, brief thoughts on clean energy. And Mario, you're still open, so we'll keep it with you.
Yeah, it's definitely a great, important part of the mega trend. I think, the tricky part of investing in a mega trend is that you're almost guaranteed to lose your money unless you're investing under a catalyst. So there needs to be something happening. It needs to be big. In this case, it needs to be likely policy. But we had a pandemic that was a big event. We had a war that was a big event. We need foundational political will from the European Union to go in a certain direction. We need something big. So that's when we're probably going to jump on the theme with a directional approach. And the other part I would highlight as a trade, last year we made quite a successful trade in carbon credits, which I think it's a very interesting area because it's a gray area between finance, policy. It's a new market developing. It's a cap and trade market. It's extremely interesting, and you see how the public sector and the private sector can come together and create something that's powerful for investors and the people as well.
No, very good. And Joel, your mic is live, so I'll go to you. Brief thoughts on this one?
Yeah, we're massively bullish on clean energy, as you can imagine. We invest across the entire green or clean energy space. We tend to focus more on the picks and shovels than the developers, but we're also involved in the developers of renewable energy. If I had to pick like one area that I think is maybe the most interesting, that I think might cause the most disruption or most and climate benefit as well, it would probably be the distributed generation piece. So in simple terms, we have a lot of people have solar on their roof, and I think that is going to continue to accelerate across the globe. Maybe not as much in Sweden because we don't have that much sun, but apart from that, what you can do with distributed generation is that people are investing in solar panels, and then they have a battery. But we also have all of these cars driving around, right, with massive batteries. So when people buy these home batteries, they're usually like a 10 kilowatt size, whereas a car could be 100 kilowatts. And what is starting to come now is this vehicle to building application or vehicle to grid, which means that you can use the car with a bidirectional charging, so that you could actually power the house with the car. So we have all of these batteries driving around, and unfortunately, like the first iterations of EVs that came out were, they never guaranteed that you could do this, so they don't have that inverter built in, but that is coming now. And that is going to make a huge difference, because if you think about the problems we have when we're going to be shutting down a lot of coal and gas plants all over the world, is that we need a lot more renewables to be installed, but we also need a lot of storage, right? Because sun and wind is intermittent. And if we can be smart about how we use the batteries that we have in cars and in home batteries that people have set up, then we have a massive battery all the time. And that, I think, is going to bring a lot of very interesting, business opportunities in what people call virtual power plants and so on. So if you're managing all of these resources, you can allocate these resources and you can direct them to where you need them at when you need them. So that space is very interesting to me.
That's very, I mean, it is very interesting and not one that I hear spoken about all that often. Julian, let's bring you in on this topic as well.
Yeah, sure. In terms of alternatives, so we do a lot of mostly the investments through the public markets, but in alternatives, what we're doing a bit more now is being equity investors in some renewable energy projects, some small, relatively mid-scale, where we know the teams. We know that the teams are very good at dealing with local authorities, getting the project off the ground, because this is an unappreciated cost for renewable energy projects. It's all the permitting and all the authorizations connecting to the grid, and this can easily be half the cost of a total project. So this is where, when we have a network of people we know that can identify the right projects, and we think that it's an interesting proposal for investors, that for our investors who don't need cash flows in the short term.
Oh, very good. And Rob, from your work and colleagues, where is your focus?
Yeah, look, I think there's a lot of exciting things happening. I'm going to echo Joel. I think solar plus storage is really exciting right now. If you look at wholesale power prices around the world right now, they're incredibly elevated. And if you look at the levelized cost of putting in a solar plus storage solution, it's way below where the markets are at. So you've got a really short payback period if you want to do solar plus storage. So I think there's a lot of opportunity there in the short run. You've got companies like SolarEdge, Enphase, really playing in this space, and a lot of the developers, SunPower, Sunrun, on down the line, that are really going heavy here. Now, that being said, look, I don't think we're going to end up in a corner solution where it's only solar plus batteries. I think we're going to need hydrogen, perhaps, or something big, other sort of technology to really help with the deep industrial carbonization. So, I would ask yourself the question, is hydrogen going to be the next LNG? Think back 15 years, LNG was this nascent little business. Could hydrogen kind of become the next emergent big thing? And I think you got to be looking for signposts there. I agree with the idea about catalysts. So the Inflation Reduction Act has some pretty big incentives for hydrogen, as well as wind, solar, and all the other stuff. But I think take a look at the policy piece, because a lot of net zero is still kind of aspirational in my view. It's not fully codified into law in many of the jurisdictions. So our policymakers are going to step up even more. I think there's strong potential for that. So that, we know clean energy is going fast, and I think a lot of the lawmakers say, we like how quickly you're moving, but how much faster can you go? So be watching those conversations. And yeah, absolutely, there's going to be some pretty exciting things this decade in the energy transition space.
Well, I will have to say that on a personal level, my son happens to be the climate change officer for a big council in the Midlands in the UK, and one of the things that they're aggressively looking at, maybe aggressive is too strong, but actively looking at, is indeed hydrogen. Not only in terms of what they can do with their own local fleet that you can imagine any municipality would have, but if they develop it for them, then the modularity of it allows it to be expanded. It's right off of the M1, and voila, you end up with a fueling depot for commercial vehicles. So there's a lot of exciting things going on with that. So at any rate, look, we've covered an awful lot of ground here. There are several questions that frankly I'd love to continue to ask, but we know everybody is busy. Time is precious. I know Rob also has a plane to catch, among other things. So why don't we bring it to a close? We will have the recording of the webinar that we can send out. I know that Rob and I both have, an iceberg of slides and research underneath it, that little tip that you saw at the very beginning that we'd be happy to share. And there's a lot of exciting content that all three of our panelists are engaged with the firms that they work with. So I appreciate your listening. Thank you, panelists, for joining us. Thank you for Evenco for setting this up. And I hope you have a great rest of your day. Thank you very much.
Thank you.
Thank you.